Hi, it's Neil Frankel with WealthResourcesGroup.com. I'm a certified financial planner, and I'm also the editor of WealthPilgrim.com. Last week was a really tough week for investors, so I thought I would share with you my thoughts, at least give you my perspective on what's happening to maybe help you make better decisions going forward. The S&P fell 3.2% on Friday, and that was after a 2.1% loss on Thursday. So it lost 5.8% for the week, and that's the worst weekly performance since 2012. And there's an index that measures fear, and it's called the VIX. And it jumped 116% last week, and that's the most it's ever climbed in 1 week. Investors are obviously scared to death. They pulled $8 billion out of the market last week, and that's the largest weekly outflow in about 4 months. So these statistics are scary. But as always, as I said, it's important to get perspective if you want to make good decisions about what to do in the future. So let's take a look and try to get some of that perspective. Up until now, the market has been stuck in a tight trading range, and it's been like that for several months, about 4 or 5 months, not going up, not going down, pretty much non-committal. And the market moved down quite a bit in only a week, so that really feels frightening. You know, in 1 week, the market went from being in the black to being underwater by a little over 4%, and that's a hard pill to swallow all at once. What's behind all this selling off? Well, obviously, as you already know, China reported some very disappointing manufacturing data, and the resulting international spill-off spilled in to our own market. And what's also worrying investors are the recessions in Latin America and Brazil and Chile, a steep break in commodity prices, especially in oil. And oil is important. It's actually a key inflation driver. But it dived below $40 a barrel on Friday, and oil hasn't been that cheap since 2009. Oh, and let's not forget about North Korea and South Korea squaring off, threatening each other and the world with total war. So that's kind of a hard, all that happening in 1 week is not easy for anybody. And taken together all at once, it's enough to shake up anybody, especially investors. But according to many pundits, the emerging market countries are really the ones facing all this economic trouble. Their problems are causing investors to overlook U.S. economic expansion and the European economic improvement. The fact is, these international problems won't probably impact corporate profitability in 2015 or 2016. That's according to the economists at Wells Fargo. Let's try to get some perspective on China for a minute. China's economy is still expanding by 6.8%. The market was expecting a 7.4% expansion, but we only got 6.8%. So that's slowing, but their economy is still expanding much faster than ours is. And as I mentioned, the U.S. is doing quite well. We have our problems, but the economy is growing. Unemployment is under 5.3%. Housing starts are at their highest level since 2007. And car manufacturers on track to have the best month in sales in over 10 years. Wages are finally increasing. Consumer spending should follow soon. Companies are still sitting on mountains of cash with healthy balance sheets, and consumer confidence is at multi-year highs. So, as I said before, probably what's behind the market decline is a little bit over-emotional reaction to what's happening overseas. I don't know how long that market purge is going to continue. Obviously, I don't know. But here are a few things to watch for that might turn that around. Number one, China could institute a rate easing policy, and that could soothe the markets relatively quickly. Investors could refocus on American growth and how relatively we're much more attractive than most other markets are, and that could bring money back into our market. And also, we're talking about an increase in interest rates. Well, a slight rate increase, which is probable, it actually could lift the market because it would signal that we're expanding and we're healthy. I can't predict the market, but there could be a bounce. Having said that, September and October are usually pretty difficult months in the market. So there's no all-clear sign. This could be a quick realignment of equity prices. The market's been doing really well for a long time, and there's always market adjustments. It's just that this has happened in a very short time. Or it could be a sign that worse things are yet to come. I just don't know. That's why I've always been a fan, and I continue to be a fan of watching the market rather than burying my head. The strategy that I use on behalf of my investors tries to do that. I do believe that for the time being, international, especially emerging market funds, pose a lot of risk. And that could change any time, but for now, I'm really glad we've been out of those areas for quite a while. I'll continue to monitor the situation. I might make changes to our portfolio soon. And if so, for sure I'll let you know. In the meantime, connect with me please if you have questions or if you'd like to discuss this any further. Thanks a lot. Have a great day.